Okay, welcome back, guys. This is the money management series, and this is the money manager's process, the most effective way to create a budget and set goals. Okay, so I want to welcome you guys back to this financial tutorial, and I want to cover some of the things that you guys are going to pick up in this tutorial. The first one is we're going to talk about income allocation, gathering information, setting practical budgets, setting impractical goals, and creating practical paths to the impractical goals. And we're also going to troubleshoot some money management issues. So it may seem like a lot, but once we get through it, you'll actually understand. But before I begin, disclaimer. The financial information contained in this video is for informational purposes only, and not for the purpose of providing specific financial advice. You should contact a financial advisor to obtain specific financial advice. Okay, guys, so this is the overview. So this is the outline, sorry. So we already finished the overview. If you guys haven't checked the overview, I definitely recommend go back and then see, because we got a lot of really good information there. Now we're at 3.1, the money manager's process, the first two steps. So just as a refresher, this is the money manager's process, where the zeroth step, or what you have to do before you even begin, is gather financial information. Step 1 is determine estimates, budget. Step 2 is create goals and aspirations. So these are the two steps that we're going to be concerned with in this video, but I have two more on the way, and those are going to be concerned with the rest of the money manager's process. Okay, so we also have evaluate budget versus goals and make necessary adjustments. We have automating the process as step 5, and step 6 is monitor and verify. This one is actually the hardest one to do, and it's the most important. So let's start off with the zeroth step, gathering financial information. So what financial information are we going to gather? Well, that actually goes back to the 4 questions that I have for effective money management. We're actually going to use that in order to figure out we're going to use that to figure out what financial information we're going to be pulling. So remembering the questions, first one being how much income is coming in. So this one, you can use pay stubs, you can use bank accounts if you get it direct deposited or you deposit it into your bank account. And a lot of the times you can find this information online at whatever HR sites that's associated with your job or business. I'm not too sure exactly who's going to be watching this, so I want to make it general enough for you guys to take something away from it. So we have that for the first one. For the next one is how much money is going out. So if you have receipts, definitely use receipts. If you have your bank statements, these tend to be the best ones, assuming that you didn't take them out in cash. And there's also a register. So if you guys have if you have a checking account and you actually use the register that comes with the checks, those allow you to put in entries for bookkeeping, and you can use that to figure out what your balance is supposed to be. And the last one is a money management tool. One of the best ones that I've found is mint.com, and there's also Smart Credit. I'm also recommending people to use Smart Credit, especially if you have the FPS protection plan. That's on another step, but the next one is how much debt is there. So you're going to get your credit reports. I want you to get all your credit reports. There were credit reports for the 3 major bureaus: TransUnion, Equifax, and Experian. You're going to get that because not all of your credit reports are going to have the exact same information on it. This way you actually get a concise list of all of the debts that you owe. And you can also do it if you have credit card statements and if you can access it online. I would definitely recommend you do it that way too. And the last one is how much is there in savings. So the sources of these are going to be money market accounts, savings accounts, and brokerage accounts. Now, if you have what's called shoebox money, you're going to use that. You're going to use that too. Okay, so I'm gonna make this an instructional video. So for what I'm gonna ask you guys is, for the first time, just go through this entire video and just understand what you're gonna need in order to do it. And what I'm going to do is I'm going to put little plugs in, like I'm going to do now, for if you're actually going to go through the process during the video. So what I'm going to say here is, this is the time to pause the video. So if you guys are going through the process, pause the video here. Okay, moving on. We're going to go to step 1, create a budget. And this is going to be part 1. We're going to do anything associated with income. So now we're going to be determining estimates. The first part, like I said before, is going to be budgets. It's going to be income. It's going to be income. So what I want you guys to do is I want you guys to add up your income from all sources individually for the past 3 months. Now start from the date of the last check. Now what you're going to do now is you're going to take the average per pay cycle. Then you're going to determine how much you got paid. You can do it daily, weekly, bi-weekly, monthly, quarterly, or annually, depending on how you got paid. Now, for some of you guys may think that that's a little kind of cumbersome to do. So what I have here is I have an example to explain exactly what I want you to do. So we have 2 income sources here. The first one is from a grocery store that pays weekly. And then the second one is a dividend payment that's issued quarterly or every 3 months. So what I want you to do for the grocery store that gets paid weekly is I want you to sum up all of your weekly paychecks and divide by the total number of paychecks, typically somewhere between 12 to 14. And that's how you determine your average per pay cycle. Now for the second one, being that you have a dividend that pays out quarterly, just remember quarterly means 3 months. So whatever your dividend payment was, that's what you're going to use for this part. Okay. Now moving on to the next step, we need to figure out what your worst practical case is. So when I say worst practical case, all I really want you to understand is this is the worst case that you can plan for. Now, the worst case would be if your income went to zero. If your income went to zero, then we're gonna have a plan set up about that. But that's gonna be risk management. But what I want you to do here is I want you to find your worst practical case income. So what we're gonna do is once you determine the average for each income source, then we're gonna do variance and standard deviation. So variance we're gonna use to figure out how reliable your average is. So like I said in the first video, for some of you guys, using the average is going to be okay because your income's not fluctuating a lot. But if your income is fluctuating a lot, then what's going to happen is you already know you cannot use an average. So what we're going to do now is we're going to mathematically prove how reliable your income is. So what you see halfway down on right next to variance is you're going to see the formula for how we figure out what variance is. Where the X bar with the X with a line on top of it is the average. The big N is the total number of data points, i.e. paychecks, and X is each individual paycheck. Now, ultimately, the closer to zero the variance is, the more reliable your average is. Now, this has a lot of different things. It is also going to depend on the fluctuation and the total number of data points that you have. But what I'm going to do is I'm going to give you an examples. Okay, so this is the example. We have one on the left and one on the right. So the one on the left, what we have is what happens when your income doesn't fluctuate at all. So we have a payout of weekly, and we have 3 paychecks, all $1,000 each. So if we take the average being the sum of $3,000 for each one, and dividing it by a total number of 3 paychecks, what we get is an average of 1,000 per paycheck. Which, if you look at it, yeah, I guess it would have been obvious, but here's where it gets a little more involved. Now, what we're going to do is we're going to figure out what the variance is. Now, being that each one of the paychecks is exactly $1,000, once you go through the math, what you notice is you end up with a variance of 0. That's because there's no fluctuation with each individual paycheck. But what you'll notice if we go to the right side is I started off with 5,000, and then I went up each paycheck with 5,000. So what you notice here is you're going to notice that the average is still $3,000 divided by 3 checks. And that's going to give you an average of $1,000 per paycheck. Now, this one is just to illustrate, though, that even though you do have an average, you see that each set of points has different values. Now, I did that on purpose just to show you this next part with the variance. Now, the variance, once you set it up, you have each point with which what you end up with is 500 squared plus 0 plus negative 500 squared. Now, the reason why you're squaring it is because if you do not square it, what's going to end up happening is if you just summed up those 3, you'll end up with 0, the same way that you would on the left side. The main issue there is that doesn't give you any useful information. So we're squaring the terms so that we have something useful to use. So after we do the squaring and we go through the math, what we have is a variance of 500,000 divided by 3. So our variance for this particular problem is going to be 166,666.67. So now that we have some idea of how reliable our answer is, we're going to switch over to standard deviation. So if you do variance and you see that your answer is really reliable, then by all means use the average. But if you find out that your answer is not reliable, we're going to go through these next set of steps. So the first one was to figure out whatever the variance is. Now we're going to figure out what the standard deviation is. Now, in very simple terms, all you're really going to do is you're going to get whatever you have for the variance, and you're going to take the square root of it. Now, this one is going to show us our tendency for each individual data point, i.e. check, to differ from whatever average you found. So what I have here is I have a bell curve. If you guys have ever taken probability and statistics in school, you've probably seen this curve before. And if you were never good at it, like I was in high school, don't worry about it. I honestly didn't understand this until I got into college, and then I actually got to practically use it. But what you're going to see now is, if you see the bottom, what I'm going to show you is you're going to see 2, and this is the Greek letter sigma. On the other side, you also have a 2 and another sigma. So what I'm going to tell you guys is, if you sum up the percentages here from negative 2 sigma to positive 2 sigma, what you end up with is 95.4%. So that shows you, if you take the standard deviation is represented by sigma. If you take the standard deviation and multiply it by 2 on one side, where the 0 here, this is This is the average. So the 0 that you see here, that is the average. So if you take something from 2 standard deviations down from the average and 2 standard deviations above the average, you're going to cover about 95.4% of all current data. Essentially what that means is less than 4%. Well, it's probably a little more than 4%. Probably like 4.4. Yeah, I should have done the math before I did that. But all that really means is less than 5% of all of the values fall outside of 2 standard deviations below and above. Now that is going to be very important because that's how we're going to figure out what your worst practical case income is going to be. So now what you're going to see is you're going to see the exact same example from before. Remember that the variance is 0 on the left, so the standard deviation is also going to be 0. But on the right, being that we have a variance of that number, if we take the square root of that number, we're going to end up with 4.8 and change, which is what you see on the right hand side. So now the only problem with using standard deviations is you can't use standard deviation as it is. You have to adjust for set size or sample set size. So what you're going to see us use is we're going to use the standard error of the mean. So the standard error of the mean, essentially all you really have to do is you have to take the standard deviation and then you divide by the square root of the total number of points that you have. Now, if this is a little cumbersome, don't worry too much. All you really need to know is once you have the standard deviation and you divide by the value that I brought up before, you're going to use this in order to figure out your budget. And there's good news here. You can actually find this stuff all online. Yeah, I'm not doing that to be mean. If you guys actually hated math and you're kind of like, Alex, why did you just put me through all that? Just know this. I wanted to give you guys the logic and the rationale behind it before I actually just gave you the numbers. So we're going to go back to the problem before. So remember the variance was 0, so the standard deviation is 0, and the standard error is also going to be 0. What we're going to see on the right is being that we have a standard deviation of 804 and change. If we take the square root of 3 and divide it by the standard deviation, we get a standard error of 235.7023. And this is how we're going to figure out whatever the practical range. So the practical range, we're going to take the standard error, multiply by 2. And for the lower bound, what we're going to do is we're going to subtract that number by the average, and we're going to take that number and multiply it. Not multiply it, but add it to whatever the average is. And what that's going to give us is that's going to give us our practical range. Now, what you may notice about this practical range is you may notice that there's only one point that this one actually covers. It comes really close to 500 and really close to 1500, but it only covers 1 point. The main reason why it only covers 1 point is because we're only using three data points. The more data points you use, the better the answer is going to be. So once we figure out what our practical case income is for each individual source, we're going to convert it into months. So this, in most cases, is not going to be all that difficult. But what I want you to do is, if you guys get paid weekly, that means in the course of a year, you're going to get 52 paychecks. And that also means that since there's only 12 months in a year, you're going to take 52 and divide it by 12. And what this is going to give you is it's going to give you a total of 4.3 repeating. Okay. Now, instead of actually doing the 52 divided by 12, you can also take the number 13 and divide it by 3. That'll actually make the equal for the calculation. Now, if you guys get paid bi-weekly, remember, you get paid every other week, so that's going to be a total of 26 paychecks in the course of a year. Divide that by 12 months. So what you guys are going to get here is you guys are going to get a number close to 2.166 repeating. And this is going to be this is the total number of bi weeks per month. And that's all. And you can also take the number 13 and divide it by 6. Now, if you guys are wondering why is it that if you get paid weekly or bi-weekly, why are you taking the total paychecks per year and then divided by months? And the truth is because what you guys have probably realized, 1 to 2 months, well, anywhere between 2 to 4 months per year, you may have certain months where you actually have an extra paycheck. What we're trying to do here is we're trying to isolate that. The main problem is the fact that if you take 12 months and you take 4 weeks, then you end up with 48 weeks. But that's not true. There's 52 weeks in a year. So we have to account for that, and that's what we're doing here. Now, for all of the other ones, it's really basic multiplication and division to convert it to months. Okay, so now what we're going to do is we're going to convert whatever the worst case practical income is to monthly figure, and then what we're going to do is we're going to sum up that for all income sources. Now, once you do that, you have completed the first part. Congratulations. And if you guys don't, and if you guys are following this as far as the instructional part is concerned, feel free to pause here. Okay, let's move on. Moving on to step 1, part 2, all expenses. Now, one of the problems with expenses is they can be very ambiguous, especially if you guys have done stuff like you've taken out cash and you've just pay for it cash and you don't have the receipt. So one of the things that's really important to do here is to actually have some sort of idea of how much money you're spending. So what I want you guys to do is I want you guys, whatever receipts you can find, if you have a register for balancing checks, I want you to use that. If you have bank statements, I want you to take your bank statements and use that. If you have QuickBooks, use QuickBooks, and I want you to do it for the past 3 months. Now, the second thing that we're going to do is we're going to separate them into 2 categories. The first categories are fixed expenses, and the second categories are variable expenses. So fixed expenses are exactly how it sounds. It's things that do not change, or at the very least do not fluctuate a lot. So this is going to be like rent and mortgage. Now, I know with utilities tend to fluctuate. I still decided to put it here for ease of use, and we also have your phone bill. Depending on what kind of phone contract you have, it could fluctuate, but I decided just to put it here. Now, for variable, what we have gas, because I know chances are this is the easiest one to identify as variable, and we also have dining out. So if you guys are following this as an instructional guide, I'm going to ask you to pause here before we proceed. Okay, now let's move on. There's something else that I want you guys to be aware of, and this is called supplemental income credit. So what happens sometimes with credit cards is people don't necessarily pay attention to the balance. They just know when their credit card is due, and they take some money that's above whatever the minimum payment is, and then they put it towards the credit card, but they don't necessarily pay it off. The problem is if you don't pay off whatever you purchase on a credit card at the end of the month, then essentially what you're doing is you're using it as income. So supplemental income, as far as credit is concerned, is considered if the credit cards or other loan that you're using, other revolving loans that you're using, the payment isn't paid off in full every month. And what you guys are going to do is you're going to include this in your variable expenses. Now, once again, anything can happen in 3 months. I'm not saying that, but if we go back 3 months and I see a credit card bill that's about the same and is close to the limit, then that's an indication that you're using it for supplemental income. Okay, so now what we're going to talk about is we're going to talk about worst practical case expense. So we're going to talk about fixed expense and variable expense. On the left side, we have fixed expense. So you just need to figure those out, sum them up, and then you're going to multiply them by 1.5 or increase them by 5%. This one's going to create a buffer for your fixed expenses. You may be wondering, why do you need a buffer? Alex, you were talking about not using a buffer, but actually doing it using standard deviation and all that kind of stuff. But you gotta remember, with fixed expenses, they don't tend to fluctuate, but we also want to give ourselves a little bit of wiggle room. Now, once you figure that out, you figured out whatever your worst practical case income is. The next thing that you're going to do is you're going to figure out what your worst practical case variable expenses. So this one, you're going to repeat the process that you did for your income. So remember all the stuff that we brought up from before. You're actually going to do that. The only difference, instead of taking the lower bound, you're going to take the upper bound. So just so you guys know, this is everything. After you have all of financial information, you're going to take the average for each individual payment, and then you're going to take the variance to see how reliable it is. And if it's not reliable, then you're going to take the standard deviation and then find the standard error. You're going to create the range, and remembering how we created the range before. For income, you're going to use the lower bound for whatever you find on the income side. But being that this is expense, you're going to use the upper bound. And that is when you take the standard error, multiply it by 2, and then add it to the average. So now we need to figure out what your worst practical case expenses are. So that is going to be your worst practical case fixed expenses plus your worst practical case variable expenses. Once you take those two numbers and add them together, that is your worst practical case expense. So if you guys don't know yet, pause here if you're actually doing the activity. Okay. Moving on to part 3 of step 1, create a budget. This one is going to be debt. So I know in the last one, you guys some of you guys were wondering about credit checks. This is actually where we're going to cover credit checks in the money manager process. So what we're going to do first is we're going to get an itemized list of all of the debts that are owed. So what we're going to do is we're either going to get a aggregate credit report, or we're going to get a credit report from each individual bureau. So remember, that's Equifax, TransUnion, and Experian. So we're going to get one from each one of those, so we have all the information that we need. Now, if you get an aggregate report, the aggregate report has to have everything in it. If it doesn't have everything in it, then you can't really use it because you're missing debts. Or you can get it from directly from the creditor. So if you have the information from the creditor, feel free to use it then. Then I want you guys to figure out, once you figure out all the debts owed and the amounts owed for each individual debt, is I want you to figure out what your debt service is. So if you guys remember from the last video, what I told you about a debt service. The debt service is the minimum amount due to keep a credit account current. So to give you context on what that means, let's say you have a credit card that has a minimum payment of $25 due every month. Then your debt service is $25 for this credit card. Now, what I want you to do is I want you to do this for all financial obligations. If you have a mortgage on the house, you're going to leave that out of your debt service because that's considered housing. Okay, moving on to the next step, we have savings. So now for savings, this is actually the easiest one of the three that we did. So for savings, all you're gonna do is you're gonna gather whatever information that you have related to it, and that's going to be any funds in a savings account, a brokerage account, or a money market account. Now we are going to exclude anything in a certificate of deposit CD or a savings bond. We're going to omit anything for retirement. So 401ks or IRAs do not qualify here. A Coverdell or 529 plan also do not apply. And the main reason is because these are not liquid. You can't pull out the money if you need to, and there's a specific reason that you have this particular vehicle. So that actually disqualifies them. So you can pause the video here. Okay. Moving on to step 5. Step 5 is the income allocation. So if you guys remember from the previous video, I showed you what the ideal income allocation is, and essentially the reason why we're using this is because this is the most effective framework that you can use in order to increase your income or reduce your expenses. So what we have on the left side is the ideal income allocation. So that is going to be housing at 30%, all other necessary expenses at 30%. And we have leisure, so that's guilt-free spending, that is 10%. We have your debt service, remember what your debt service is, at 20%. And we have your savings rate, or the amount that you're going to set aside for investing, at 10%, giving us a total of 100%. Now, in most cases, if you haven't looked into money management, this is probably what you're going to see. You're going to see housing at about 40%. Of the necessary expenses are about 20. You have about 25% for guilt-free spending, and you have a debt service of 25%. You have a savings rate of 1%, giving us a total of 110%. Now, you might be wondering, how can you live on 110% of your income? Now, remember what I told you before, supplemental income credit. The main reason why people do this is because they're using their credit cards as a form of income. And if you also notice, what you'll see is your savings rate is less than zero. In most cases, when people don't pay attention, something like what you see on the right side is what's bound to happen. So what I want you guys to do now is I want you guys to take whatever your worst practical case income is and then apply it the same way that you see on the left. And I want you to take your expenses, all the expenses that you have, and I want you to apply it to the one on the right. And then I want you guys to take a look at it, because this is going to tell you how you've been spending your money and how you need to spend your money. Okay? So if you guys are following this as far as the instructions are concerned, pause the video here. Okay? So now, step 1 is complete. You have your worst practical case income. You have your worst practical case expenses. You know what your debt service is and how much debt you have outstanding. You know how much you have in liquid assets. You've already done a comparison. You also done a comparison, so you know what income allocation you need to have. Now we're going to move on to step 2. And step 2 is setting goals. So if you guys didn't like the very pragmatic mathematical step 1, then you're going to love step 2. So step 2 is setting goals, and this one has a disclaimer, not so much a legal disclaimer like you saw above at the beginning of the video, but you're going to see this one, and I have down as this. For this step to work, you cannot think practically. You have to give up whatever limiting beliefs that you have, and you're going to have to approach it as such. Now, this is going to be a struggle for some of you guys because you probably aren't used to doing this. And what I say that is, you're probably not used to having to be mathematical and pragmatic the same way that you are in step 1. And here where you can't do that. If you do that, then you're going to automatically think about what's possible now, and that is not going to work. So what we're going to do now is what you see as follows. This is ultimately how you're going to figure it out. So what I want you guys to do now is I want you guys to answer a couple questions, and you can pause the video for each individual question. And if you want to write down your answers, feel free to. But the most important thing that I want for you guys to do is I want you guys to think about it. So for the first one, how do you want to live? What do you want to do? What do you want to do with your day? Where do you want to live? What kind of work fulfills you? What do you want to drive? What's your ideal form of entertainment? Sorry about that. Who's around you? What kind of partner do you want to have? Okay. All right, guys. Thank you for watching this video. I know this one is a little bit longer than it normally is, but I want to thank you for sticking with me, especially through the mathematical part. For those of you guys who are pragmatic and mathematical, thank you for sticking through the more abstract step 2. So we still have two more money manager process videos to do. What I want you guys to do now is, if you guys like this video, hit the thumbs up. In the comments, I want you guys to answer two questions. The first one is, how do you feel about your current income allocation? You don't have to tell me what it is, just tell me how you feel about it. And the second one is, how do you want to live? That's the less pragmatic thing that we were talking about in step 2. So if you guys want more videos like this and more financial tutorials, I want you to subscribe to the channel, and you'll get updates anytime I release a new one. And with that, I want to thank you guys for staying with me.